So hi everyone, my name is Bilal and Alamy. I'll be your host for the next half an hour, and I'll be introducing the subject of how blockchain technology is improving financial markets and capital markets. So let's wait just a couple of minutes before I start. Maybe some more people will be joining. So just to give you a little bit of background, I'm the co-founder and CEO of Equisafe. We're a tech company based in France. We are known to be responsible for the first real estate transaction in Europe. We also done the first retail investor secondary trades. We've done also the first real estate tokenization on Tezos. This project was launched on the beginning of March at the French consulate in New York. And so, yeah, we'll be talking about how blockchain is reshaping the financial industry with different approaches. You have the regulatory approach, you have the technological approach, you have the how can I call it? Well, you have the finance and capital markets approach. So I'm going to share my screen just before we start. Okay, desktop. Everyone sees my desktop. So at Equisafe, we really believe that blockchain is the path forward in terms of digitization in the financial industry. So it's well known. So my background was a strategy consultant at Accenture. So I was working, specialized in financial services. So I can tell you by experience that the digital transformation didn't touch the financial industry as much as it touched supply chain, healthcare, marketing. Why that? Because there is a very simple thing that is called a share ledger or the shares registry that every company needs to hold. And this shares registry was a piece of paper where you basically had your lawyers and your expert accountant who were supposed to update this shareholder registry manually each time a non-listed a trade of a non-listing company was being done. So for a listed company, it's pretty much digitized. You have, of course, the public market, and you have gateways where you can just go and buy some Google shares, but you don't have that for private securities, or you have very small marketplaces that do that because of this ledger that is paper-based. And today with blockchain, which is a digital ledger, we can put this shares registry within a smart contract that will govern the way you can change or mutate this ledger. And blockchain brings a second layer that is very interesting. It's the proof that the proof system that is blockchain. So in most of the countries in the world, you had some laws that were passed on saying that blockchain is a proof system. And if you have the hash of a transaction, you can go to the judge, show him this hash, and it will acknowledge that you are the appropriate owner of this shares. So two things: the ledger that is now digital, and the fact that it's a proof system. And once you have that, you're able to digitize the shares registry. You're able to infuse the whole value chain and improve the whole value chain from transaction to KYCs to distribution to governance, because with those smart contracts, which are very powerful tools, which is nothing less actually than just code logic that is being executed, but on a proof system here. And so the kind of governance rules that you can encode is typically the shareholders' agreement in order to automate the cession and acquisition of those shares. So just to sum up, Equisafe is a digital investment banking infrastructure. So investment bankers are known to facilitate transactions. And by using this marketplace that we're building, we want to facilitate transactions for non-listed companies. And so to do that, we've built a multi-service platforms which allows both the issuance, but also the distribution, the investor management, and the liquidity of those private securities, because we have embedded some a marketplace where you can buy and resell your real shares. So what's the problem with the markets? That they are very large and inefficient because of the infrastructure, which is paper-based, like I mentioned it. And because of this paper-based, the settlement is very long. There is a lot of data silos also between all the parties that are supposed to work together. Take, for example, a real estate transaction. You have the notaries, you have the lawyers, you have the seller, the buyer, the valuation company, and all those third parties, they need to work together. And you know that blockchain is the perfect collaborative tool because it's both public, but each smart contract can be permissioned so that you can access it and read the information or get the information, but not understanding it. And so the idea is to build well, to go from data silos to data room that are built on the blockchain, giving some more traceability to each document that are used, for example. But that's just a feature on top of it. I've mentioned it, there is also a heavy compliance burden. This heavy compliance burden comes from the complexity of the shareholders' agreement or the rules of a specific fund. And with the smart contract, you can encode those this compliance. It is compliance because you can code which nationality can hold them, the limit of investors that can hold them, the accreditation levels that is required to buy them, maybe a vesting period, and so on and so forth. The fact of the problem with the data silos come also from that there is a lack of coordination between the third parties. And all these silos, lack of coordination, creates a very ineffective matching between the demand and the supply. So basically, it's easy. You want to buy a share of Google, you go to the Nasdaq exchange or to the brokers that work with this Nasdaq exchange, and you can buy those securities. But if you want to buy one from Equisafe, it's very hard to know about it, but also to invest about it because the process is manual. It's expensive, and of course, the more investors you have in your cap table, the more difficult the governance is. And with blockchain, whether you have 10 investors or 100,000, it's exactly the same because all the governance is automated. So blockchain brings, to sum up, a record of ownership. It brings a solution for collaborative problems. It's decentralized and gives trust in the system. This trust is the proof system that I was talking about. It's full transparent and auditable, but it's also private because you cannot read clearly all the information that you have on the blockchain. You need to have the required information to be able to compare them. And of course, the instant settlement capabilities that are given by blockchain in a world where we have access to information, we have access to the news and the movies and the music that we want, a world where the payments are becoming more and more instant, what we call the delivery versus payments it's the transaction where you exchange cash between securities, which usually takes between 2 and 21 days, depending on the kind of securities that you're buying. With blockchain, we can make that instant because we're solving what we call the double spending problem, which avoids the deduplication of some informations in the database. And so, like I said in the introduction, blockchain brings three things: the timestamped, that is a legal proof. It brings the programmability of the smart contract, and it brings the security and the immutability of the information, which allows you to have to decrease your risks. And the shares registry that I was talking about, they really look like a book, and they haven't evolved since the Mesopotamian era. So basically, it went through from a tablet to paper to Excel, and now it's about blockchain. So it's the evolution of the ledger technology, which allows you to store information. So if you want to compare kind of the processes in the legacy infrastructure and in the digital infrastructure. So in the legacy infrastructure, the time to settle goes from days to weeks. So you probably all heard that when you want to buy a share of Google, you actually becomes, so first of all, you're not buying the share of Google, you're buying an entitlement to your broker dealer who holds the share of Google for you. And two, the time between the moment where you pay and the moment where you become the real owner of the securities, it takes usually 2 days. So you all heard that when you buy a share of Google, it takes at least 2 days. When you want to buy debt, it takes almost 20 days. When you want to buy real estate, it takes almost 6 months. And so if you take that back from to the securities and want to improve the settlements from days, you have to automate all this process. So actually, when you want to buy a share of Google, you will engage with your broker dealer. He will perform the KYC. He will negotiate the price. Then he will confirm that the trade is compliant and permissible by comparing the rules of the shareholders agreement and the rules of your KYC. And then he's going to validate the ownership, escrow the payments, and do the delivery versus payment, and deliver the securities. And by delivering the securities, we mean updating the cap table, which was done manually. And so all these processes, just to give you an example, just a KYC for one person, when you do it manually, it takes at least 3 days. If you want to check the permissibility of a transaction, you need to reread the full shareholders agreement. It's the kind of document that holds between 50 and 100 pages. So it's kind of very time consuming in order to be able to understand what's the condition on which a trade can be performed. With the digital ledger, with the automated compliance, we can automate all of that and have this delivery versus payment happening almost instant. And this is really the improvement of the post-trade infrastructure in capital markets. And this improvement will bring more liquidity, because there is two factors of the liquidity. You have the liquidity on the primary market. So if you're able to hold 100,000 investors, you can fractionalize more the entry ticket, and so it's easier. The cost of capital is easier to get into an investment. The second part is on the secondary market. So the liquidity is the time that it takes you to exchange your securities on with cash on the secondary market. And of course, if the information is more transparent, more accessible, if the user experience is made better with a digital infrastructure, it will be definitely more interesting, and it will bring the liquidity that we were talking about. So the blockchain-based securities, just to sum up, you can fractional ownership way more than you can do it with traditional paper-based certificates, because the governance is automated. Since the governance is automated, you don't have to supervise the trades, and you can open the market to 24/7 trades because you know the automated compliance will do its job, and you don't need the 3 days to perform a KYC and all the process at the head of compliance. The settlement is made quicker. This will increase liquidity, and of course, improving capital markets infrastructure will reduce costs of capital, but will also reduce costs of the lifecycle management of your securities. So obviously, when you want to, for example, do a general assembly of 100,000 people, if you're doing that paper-based, it's definitely very complicated to make them all bot. You have to reserve the place, you have to reserve the food, you have to reserve the lawyer who will do the paperwork, you have to organize all of that. And so improving it with digital tools improve the cost benefit. If you want to build this kind of infrastructure, you need multiple layers. So of course you have those two first layers that are the blockchain-based layers. It's the smart contract that I was talking about. The first one is the protocol, where you can hold the different rules from the shareholders agreement. And another one is the identity management that will be able to automate the import. So for example, today, each time you want to invest, you're supposed to reperform your KYC. But there is a European regulation that says you can use the same KYC for 1 year. But the different third parties were not trusting themselves and they were redoing the KYC. But with blockchain technology, you can do it just once, and then you can put this in a smart contract. This information can be trusted, and since it can be trusted, it can be shared by the other parties. And once again, you improve both the user experience, but also the speed of the process, whether you want to invest or resell your shares. So of course, when we're talking about blockchain, you need wallets, you need private keys and public keys. Most of the people, they're afraid when we're talking about that, but when you unlock your phone, you basically unlocking it with your private keys. So for example, the Touch ID for unlocking my phone works with private and public keys. Then you have a payment system. You need a payment system. So in order to leverage the full capabilities of blockchain, you need what we call a stable coin, or like Tether, USD TET, USDC from Circle. We're working on kind of a Euro token here in France, and the idea is to create a new medium of central bank digital currencies in order to have the delivery versus payment happening both, the payment and the delivery of the shares happening both on the blockchain. So you won't have an instant settlement if you're not using a stablecoin on the blockchain. So there's two ways here to do it. Either you can have people using real crypto and they know they're using crypto to pay. Either you kind of hide it in and as being not so user-friendly technology because you had to go on an exchange, buy your securities, then you had to go okay, internet's back online. You had to go on an exchange, buy some ethers, then you have to send them back to your wallet, plug your wallet to the specific service, copy pasting public keys, signing with private keys. So the user experience was definitely very complex because it was scattered and it was still using a lot of vocabulary coming from the blockchain that the mainstream people don't necessarily understand. And so the idea is to build this one-stop shop platform where you can embed all those services in order to improve the user experience, but also making disappear all the blockchain words, because what we're doing here is finance. It's fintech, but it's definitely finance. So when you want to sell an investment, you'd better use the same vocabulary that another investment from the legacy infrastructure is using, because in the end, you're investing in an asset. You're not investing in blockchain. Blockchain is just a medium. It's kind of the evolution of paper. Before that, you had paper shares certificates. Now it's digitized. It's on the blockchain. So it's just a different medium. There's nothing to be afraid of it. Actually, there is actually less systemic risk using a blockchain infrastructure, because, for example, when you're using a paper, you can burn it, you can lose it, you can have a natural catastrophe. You never know. With blockchain, it's immutable. Whatever happens, it's still there, except, of course, if the internet crashed down entirely. So if you guys are interested, I can kind of deep dive in what kind of the architecture of the smart contracts look like. So if you're familiar with financial vocabulary, you should be able to understand what I'll be saying. So why it's important to create those smart contracts? It's important to simplify reporting requirements and regulatory supervision. So the reporting, so I know that investment funds, they spend almost 20% of their time doing reporting. And if this information is digitized, you can basically get it very easily and automate the extraction of this report. So it's very important. It's a huge improvement in terms of reporting. In terms of regulatory supervision, you have a lot of regulatory approaches with the beneficial owners, with the custody, with the transfer of the securities. Of course, having this transparent ledger that is shared will improve the regulatory supervision. Second point, very important, you need to be able to tokenize equity-based securities and debt, because a lot of the other kind of securities are a bundle of those two securities. So it's kind of the major foundation that you need to be able to handle. And third, what we call the on-chain governance. It means basically encoding the shareholders' agreement and the restriction on-chain, so that wherever happens the transaction, whether it's on your exchange or another one's exchange, you can still enforce the compliance. Because if you extract the compliance from the blockchain and you put it in your database, you are avoiding the proof that brings blockchain, and you won't be able to control or prove why a specific transaction happens. So the most extended standard on Ethereum is called the ERC20. Just for your information, at Equisafe, we've built both on Ethereum and on Tezos, and the full standard is called the NIX standard. ERC20 is just the very basis of this standard, because it's a set of common functions that are shared by different providers. And then we're building multiple smart contracts which have a very specific rules for each one of them. So obviously you have the KYC registrar that will hold the information and allows you to share this KYC. But you also have the issuing entity and the security token. The issuing entity holds all the information of the shareholders' agreement, and each security token represents a kind of asset class. So for example, here it can be a company holding ordinary shares and preference shares. And then you can attach modules. So here you can attach modules that hold restrictions, and here you can attach modules that holds, for example, a dividend smart contract or fixed income. So obviously, if here it's an ordinary shares, this one would be a dividend. But if it's, for example, ordinary shares and a bond, this would be a fixed income. So the idea was to build something very modular in order to build, whether you're building an X-Wing or a Falcon Millennium, with the same basis part in the beginning. Here, it could be an investment funds, deploying multiple investment funds with different subscription models. And of course, you have the multi-sig in order to have privacy and control over both the keys and the different players that need to sign a specific transaction. And we've created something new for this also. We created what we call the multi-authority. So the multi-authority is a tool for regulators. It allows regulators to access those KYC registrars and be able to restrict people from the nationality of the regulator. So if, for example, I give access to the SEC, to the multi-authority, they will be able to restrict only American citizens. BaFin German and the AMF, the French regulatory financial market regulator, will be able to restrict only French people. This allows you to basically, when I restrict one people here, if you invested in multiple shares, it will be restricted everywhere. Otherwise, I would have to do it like I'm doing it today, meaning calling every issuers and ask them if basically they have the shareholders in their ledger. Another question that is, another approach that is very important is the identification. So I was talking about the KYC registrar who holds the information. Most of the questions that I get is basically, okay, so you're holding identities on the blockchain. Is it GDPR compliant? So blockchain and GDPR is not antinomic. They can work together because, for example, here, I'm not storing any personal data. I'm storing the hash of your identity. So it's not your identity that I can read. I'm storing just a country, a region, an accreditation level. For example, if you're an accredited investors, or if you're retail investors, or maybe you're professional investors, or maybe you're sophisticated investors. There are different rules depending on different countries. You can put the expiry dates of your KYC and all the different addresses that are linked to a specific identity. And this will allow me to automate the KYC check, the KYC sharing, the transaction permissibility without having to store any of your personal information. And yeah, so the permissioning between off-chain and on-chain compliance, I've mentioned it, is definitely more interesting to have it on-chain. So it's more expensive in terms of cash, but at least you're sure you have an instant settlement, and at least you're sure you have more transparency and auditability of those transactions. So the idea is to be able to, so tokenization, meaning the digitization on a blockchain of shares, need a lot of components. It needs, of course, KYC and AML and accreditation process. It needs the ability to escrow fiat. It needs the ability to have financial reporting, to have a communication channel between the investors and the issuer. It needs to have both cap table management features and governance features. But this is just kind of the basic services. Then when you're handling securities, you want to be able to have at the same place all the documents that you've signed that are related to your investments. You want to have in the same place the secondary market. You want to have in the same place what we call recovery features. If, for example, I've done a transaction that, okay, let's say, for example, I want to share, I want to send shares to Bob, and actually I copy paste Alice's private keys. So in a classical blockchain infrastructure, you won't be able to reverse this transaction. But here, if you met specific, if you meet specific guidelines, you will be able to recover a specific transaction. You also want to have a lot of security consideration, because you want an answer when you're asking, okay, what if I lose my private key? Am I losing my shares? No, because of those recovery features, I'll be able to take your shares and associate them to another key. What if my smart contract is compromised? I also need a very specific procedure in order to be able to recover the state of a full ledger if one of my smart contracts is compromised. And of course, it's not just about the token generator event. A token don't have any meaning if you don't have the ecosystem to make it live. And within the ecosystem, you need to be able to handle reassurance, redemption, of course, token freezing if you want to make a share non-transferable, and you need, of course, the dividends and the buyback depending on the kind of securities that you'll be handling. If I just go back and take a transaction value chain, So in the legacy system, it's usually advisory, structuring, distribution, then KYC and ongoing communication. So ongoing communication is the lifecycle management of the security. And so you had 2 pain points on the KYC in the onboarding of so the onboarding include 2 things. It includes KYC and AML, and it includes the payment and the electronic signature. So you had a lot of pain points here. And then you have the ongoing communication. So to address this one, you don't necessarily need blockchain, but to address the lifecycle management of the securities, you need blockchain because you need this shared digital ledger. In the framework that we are proposing, you still have this pre-offering stage, but if you make your platform collaborative, you can make people go from data silos to data rooms. And then if you put the KYC before the distribution, because you're handling an investor base and everything is digital, you'll be able to have this, to answer this first pain point. And then on the lifecycle management, the automation, the automated compliance that is brought by the blockchain that allows improvement in efficiency of transaction, which brings better liquidity in the secondary market. So just to sum up everything we've said, it's better liquidity, it's a huge cost benefit, it's being a pioneer to brand your fund or your company, but it's also accessing a new class of investors. And why that? So you still have access to retail and institutional, but you will also have access to crypto enthusiasts that trust the technology behind what they are investing it as well. And you've seen the scale of what could bring ICOs with global exposure. So here we'll be able to improve. So working with security tokens have a lot of regulatory constraints. It's not the same as ICO. The rules of distribution and addressing specific nationalities are different. But once again, the transparency that brings blockchain and the technological approach will allow you to maximize your investors' reach. You also avoid friction because I said it's increased visibility, it's compliant transfer, it's very low transaction fees. If you just take the cost structure of a transaction on the blockchain, it's an average of 5 cents per transaction. So obviously when you're using the service on Equisafe, it doesn't cost 5 cents, but it's still at least between 40 and 50% more cost effective than the legacy framework. In terms of cost benefits, if I had to size where is the cost benefits, obviously it's not on the initial offering, because on the initial offering, you'll always have to do the legal work. I mean, by legal work is, for example, building the private placement memorandum or the prospectus. You still have to do it. You still have to have accounting. You still have to execute your roadshow in order to convince investors to invest in your platform. But you still have a lot of automation that still improves the cost of doing an issuance. And then when you've issued those shares, they have to leave. And so you have the ongoing lifecycle management. And it's actually in the ongoing lifecycle management that you have more cost benefits, because it's in the ongoing life management that you have a lot of back office and middle office processes that needs to be automated and that needs to be improved in order to make the value chain more efficient. And this data is taken for a 50 million investment fund. So for a 50 million investment fund over 5 years, it has a cost structure of 1.6 million euros. But with doing digital, we can improve this by almost half. So like I was saying, traditional investors, institutional investors, new investors that couldn't accept the 4 to 10 years lockup that you can find in some investments. Because, for example, when you invest in an investment fund, let's take a VC fund. It's the biggest lockup. So when you invest in a VC fund, it's locked up 12 years for two reasons. The first reason is that the work of the VC fund is to invest into companies
Hi,
and not take.
hi. Sorry to interrupt you. I'm the next speaker. I'm
Okay,
just wondering if, because it's now it's now the time for me to be on stage. How long would you need to
I'm
wrap it
finishing
up?
in 30 seconds.
Okay, all right. Thank you.
Finishing in 30 seconds. So I was saying, yeah, VC funds have 12 years lockup. A lot of people can can invest in a VC fund, but so the minimum tickets for a VC fund is 100,000 euros. In Europe, it's the threshold for being an accredited investor. And so basically, a lot of people can put 100,000 euros, but very few people can be locked for 12 years with those 100,000 euros. And so the idea with bringing more liquidity, you will be able to address those kind of investors that don't want to be locked up. And finally, for the seller, it's better reallocation of funds, it's better regulatory needs, its ability to change exposure and restructure your portfolio with shorter allocation in order to maximize your diversification. And for the buyers, it's mitigating the effect of the G curve. So the G curve is something that is specific for investment funds. Improve the cash flow, have more insights on your performance, and of course also improve the diversification. So just to finish on this slide, of course, blockchain-based infrastructure, blockchain technology, or digital securities or security token that they are being called, they're existing for the last 2 to 3 years. It's very new. Not everything is working very well. For example, obviously the liquidity is not there yet. The distribution network is not there yet. The cost of issuance can be high because people don't know, it's not standardized. But the real value proposition is the programmability, the compliance, and the transparency that it brings. Thank you very much. I'm sorry if it took 30 minutes and if you don't have time to ask the question, but please feel free to contact me, Bilal El Alamy, on LinkedIn, or you can just send me an email at bilal.elalamy@equisafe.io. Thank you very much.